Commit to Wealth Nation, welcome to the Commit to Wealth podcast. I am your host, Juan Vargas. Today on the show, we have Keith Wasserman. In 2008, Keith founded Gelt Inc. and has since been involved in over 1.25 in acquisitions, including multifamily, industrial, and commercial assets. In 2017, he founded Happy Home Communities and has since acquired manufactured homes to add to his growing portfolio. In addition, Keith's charitable giving program called the Resident Relief Foundation focuses on helping renters avoid eviction upon an unexpected financial emergency or situation. Keith graduated in 2007 from the University of Southern California from the Marshall School of Business. Keith, it's a pleasure to have you on.
Yeah, thanks for having me. I'm excited for this one.
Yeah, so like we were discussing here just a couple minutes ago, I saw some of your earlier videos on YouTube where you were in Houston actually. And, they're pretty good videos, and obviously, we all start somewhere, but it was a good progress of how you're, doing some of your due diligence and stuff like that. So it's good to kind of, talk about that a little bit. But, before we get there, let's talk about your background, and tell us where you're calling us from.
Yeah, so I'm calling you from Los Angeles, California. I was born and raised here. As you said, I went to University of Southern California, so also LA. So I'm one of the original people that, lived here my whole life, never lived anywhere else. Most people are transplants to LA. But,
yeah.
I grew up in a very entrepreneurial family. From a very young age, I was taught the importance of, saving and investing. And my first early experience when I was 10 years old, my parents would take me to Costco and we bought boxes of candy bars, wholesale. And then we went to the park and sold them retail one by one.
Yeah.
And, just learning to make money on the buy essentially has been a recurring theme throughout my life. And when I was 16 years old, I went to downtown LA and my dad loaned me $1,000. I bought 100 leather jackets for $10 a piece. I sold them for between $75 to $100 a piece to all the parents, the teachers, everyone in my high school, and just really learned how to negotiate. And these leather jackets, they were fine, but they had little blemishes. They're called IRs, irregulars, and they couldn't be sold at the retail store. So I bought them very cheap, and I just hustled and sold them one by one. So I learned about the importance of negotiation and making money on the buy. And that led me to my next business, which was called Keith's Bargain Center. And we became one of the largest eBay stores online. From 2003 to 2007, we sold almost 200,000 items on eBay. And I was doing that from my dorm room, essentially. I had a warehouse in the San Fernando Valley in Los Angeles, around 30, 40 minutes away. I was driving back and forth from school, and I had around 13 employees, and we were consistently buying and reselling merchandise on via eBay, the platform. So also, again, learning how to make money on the buy, and then selling things that people wanted. So.
Got it, man. Yeah, that's the way to do it. You got to start somewhere. Like I said earlier, you obviously started with at a young age. That's kind of what I'm doing with my kids as well. It's kind of, he does a little bit of that. Selling some candy and stuff like that. But that it kind of drives their mindset. So I like that. I really like that. So where's the name come from? Gelt.
Yes.
Where'd you get that name from?
So Gelt. I grew up in a Jewish family, and Gelt in Yiddish means money, actually. So during Hanukkah time, they give these gold little chocolate coins, and it's called Hanukkah Gelt. So a lot of our ethos is about giving back and giving, and that's, I just wanted a cool sort of unique name that a lot of the real estate companies, they sound the same to me. So Gelt is just easy to remember, and it's differentiated, and it's all about giving. So that's how I got the name. Yeah.
Got it. No, that's nice. That's nice. So let's get into your real estate, your background and your experience. Tell us how that started.
Yeah. So I graduated USC in 2007, and I slowly started seeing more and more competition on my eBay. So eBay kept getting more and more sellers selling the same kind of items that drove the price down. eBay started charging more fees. PayPal also upped their fees. So my margins kept shrinking. I started not being able to buy the same kind of goods at the same prices. I had to pay more for those goods. So in all, I liquidated the rest of my merchandise. I stopped buying new stuff, and I tried to figure out what my next move would be. And, to tell you the truth, I've never worked for anyone in my life. I literally worked up until lunchtime for someone and then left at lunchtime. So my dad was like, it was my dad's friend, and he's like, you should at least stay for the rest of the day, jokingly. And I told the founder there, I'm like, look, I'm not a suitable employee. I've never worked for anyone. I'd rather do my own thing, very small even, but be, my own boss and figure it out myself. So he said, I understand that. I respect that. That's how I began. I came to this country with nothing, and I grew this business. It was a big real estate development and ownership company. And later on, we actually did a deal together with that gentleman. He became a mentor, and years later we did a deal, which is really cool. But I'd say always learned the importance of investing and saving. And at 13 years old, I had a bar mitzvah, received a little bit of money, and then invested that in the stock market, for example. So just always learning how to be entrepreneurial, resourceful, seeing opportunity, and saving and living beneath your means, and just it's been a great way to build wealth, for sure.
There you go. So what was your first property, your first investment property?
So December. Okay, so I graduated from USC. I got my broker's license, so I could I learned as much as I could about real estate. And then the best way to really learn is by doing. So my cousin came to me in December of 2008 with the opportunity to buy a 4-unit building in a city called Bakersfield, California, which is an oil and agriculture-based town around 2 hours north of Los Angeles. So a little bit of a schlep to drive, but we still were able to get there, and the prices were just so much cheaper. We bought our first fourplex for $150,000. It was in a rough part of town in Bakersfield. We got a 2.5% down. We did an FHA loan, so we only had to put 2.5% down. We borrowed $5,000 from a friend for that down payment, and then we got a cash advance of $10,000 on our credit card to do the rehab. So that's how we bought our first fourplex. The second fourplex was also around $150,000. I put the $35,000 down payment. We had to do, FHA is a first-time home buyer, 1 to 4 units, so you could only have one. So the second one, I put the down payment, which was, a good amount of my savings. And then my cousin, who's my business partner, got on the loan because I wouldn't qualify on the loan because I was self-employed and had a lot of write-offs, et cetera. And we just kept buying these little fourplexes. We started bringing in one investor at a time for each of these little fourplexes. And we bought 14 fourplexes in our first year of business in 2009. Which led us to our first big deal a full year later. It was a 78-unit building in Bakersfield also. We bought it for $3.9 million, and we raised $1.3 million from around 8 different investors. We rolled our entire acquisition fee back into the deal. I think it was around $150,000. So we were, big, I guess, over 10% of that 1.3. So we didn't take a dollar off the table there and just reinvested everything into the deal. And years later, we sold that for like $6.5 million and exchanged it and then sold that building. But it was really the first apartment community rather than these little fourplexes. It was the first apartment community we bought, and we learned by doing, essentially.
Got it. No, that's a great story. So your bread and butter type of property is basically, a deep value add. Is it, well, semi-deep, right? So you're looking for value add opportunities where you can, increase the value, maybe do a refi on the back end, or, sell it. And what were you selling the properties and not holding on to them?
Yeah, so the long-term goal has always been to build a large portfolio for ourselves and our investors for, long-term cash flow, appreciation. Real estate's great. You have all the tax benefits. There's something called depreciation. I don't know if you've touched on the shows and stuff, but essentially all the years of beginning years, especially of cash flow, are pretty much sheltered because of a phantom expense called depreciation. And it's not really an expense where you spend it, but you're able to write it off. And the first at least 4 or 5 years, most of our properties have had zero to maybe very little taxes that the people have to pay. All the investors get a K-1, and the depreciation flows through to them. So on paper, it'll show as a loss, even though the property will throw off cash flow. Usually between 6 to 10% has been our range on just cash on cash returns, yields from the properties, and that doesn't include any like appreciation or principal pay down when you're paying down the loan. So real estate's great. You're building wealth over time, and the real estate's going up in value over time because of rent growth and just inflation, and it costs more to rebuild certain properties and stuff. So it's a long-term game. It's not a get rich quick, but it's a get rich guaranteed over time if you have a long-term horizon and you're conservative.
Got it. So you started right there, basically in your own backyard, right? So what markets are you looking at today?
Yeah, so fast forward over the last 10 years, we built a big portfolio. We have around 600 individual investors that have invested with us in these deals. And we've acquired, around 7,500 apartment units and 1,000 mobile home park sites. and that's probably around 30 to 40 different individual properties. And we're in all the main secondary markets in the Western United States. We're in like Phoenix and Denver and Salt Lake City, Reno, Portland, Seattle, San Antonio. Even we were originally Colorado and West, but it's been tougher in the last year or two. It's been really tough to find things to buy. So we entered into the Texas market, actually, your home state. So we're opportunistic. In the beginning, we were buying deals that were just really, I guess, medium value add. Now, everything the brokers send out is value add, and we're finding deals that are just more stabilized just being better opportunities and better deals. And we're always trying to, move where the market's not, I guess, to try to identify opportunities. So the last deal we bought was in San Antonio. It was a 588 unit, 2-property portfolio in the north by the USAA headquarters. Before that, we bought a big portfolio in Seattle, not in core Seattle, but in Kent and Federal Way. So we're sort of like in the suburbs, but close by to the main, job centers where there's a lot of job growth and population growth. And we usually try to buy buildings that are a little bit older, like 70s built, 80s built, maybe 90s built, and do light renovations, spend $2,000 to $10,000 per unit renovating and lifting the rent in the process, but really providing a lot of value for the residents in terms of adding a lot of amenities, making it a better place, better management. Any maintenance request, it has to be serviced within 24 hours. So we try to make sure there's no deferred maintenance on the properties. A lot of our other owners we buy from have deferred maintenance. They just aren't good managers. They sort of let the property go, and we just really take good care of it. And we have a saying: we run it like a Honda. We don't over improve, but we take very good care of it. So because these are not ultra luxury brand new buildings. These are old buildings, but we improve them. And people like usually the older buildings because the units are larger on these new buildings. When they're building, they make very small units and high rent, but I try to find areas that are really good, strong areas that are, in these good parts of town, but just older building stock that we just renovate and improve. So.
Yeah. So I would say, the markets that you're choosing are markets that are on the uprise with population and job growth, right? Those are two main things that you're looking at, right? So, it's part of the reason why you're choosing different markets, you're specifically looking at that. So, what kind of separates you and your company, as a syndicator versus others? Why is your group different?
I always tell people you're really investing in us. It's our honesty, transparency, the way we do business. We have, quarterly reporting with all the financials, newsletter. We're constantly bringing the investors to the properties to see the properties. That's the beauty of real estate. You're not just investing in a company, you're investing in an actual piece of property, and you can see the transformation of that property. And we have very attractive terms for the investors. We're very investor friendly. And we have just a lot of repeat investors. They start telling their friends, et cetera. And I'd say, we both being fair for the investors, open and transparent. We're always available. Like we try to call the investors the golden geese that laid the golden eggs. Without investors, I wouldn't have a business. So we treat them very well, and just really try to stay on top of being open and reporting to them and showing them the good, the bad, the ugly.
Yeah. So speaking of investors, how are you structuring your deals? Give us a typical structure. What does it look like?
Yeah. So we, when we buy a property, we charge an acquisition fee of generally 1% to 2%, depends on the size of the deal. The larger the deal, the lower the percentage will be. Mm-hmm. And then our company, we charge an asset management fee of 2% of the gross revenue. We have third-party property management companies that we pay, usually call it 2% to 4%, depends on the size of the property. And that way, I never really want to be in the property management business. It's a lot of turnover, a lot of liability, a lot of, just a very tough business with, there's a lot of competition. I'd rather hire, and I probably wouldn't do as good of a job because we're in so many different states. If we were in one area, maybe we would look into that, but we rely heavily on around 4 different management companies that are the best in those different regions that we are. And we pay them, a market fee. Sometimes we've aligned ourselves where we pay them a little bit below market rate fee. And then we give them a piece of the back end. So it really incentivizes them to put their best people on our properties and it's been a real partnership with the management company. And
what does that look like? What does that look like if you put them in and, to align the interests, they're better? So what does that look like on the back end?
Yeah. So generally, like, let's say they were going to charge us 3%. They'll charge us only 2%. So now our cash flow is a little higher. Mm-hmm. And on the back end, we would give them, depends, a 0.2% of the profit essentially. And that way it's going to be probably double what they would have earned if they got their full fee. So it really aligns them well with us. And there's a lot of ways to do that. That's just one of the ways, the creative ways we did that. There's other ways we bonus the management companies based on performance and stuff, or do a combination. But really you want to try to align yourselves, if you're not doing your own property management, align yourselves with the management company, because typically they get paid on the gross revenue. They don't really get paid on, we call it like they spend money like the government. They just, could go crazy spending money. So because they get paid on the top line revenue, not on performance. So we try to align ourselves with them in that way to make sure we're hitting our, NOI and that we projected. Exactly.
So you mentioned that your structure is basically, acquisition fee, in most cases, an asset management fee. So what about the back end, with your investors?
On the back end, we have a full return of capital. So if investor puts $100,000 in, they'll get their full $100,000 back upon sale. And then it's a 70-30 split. So they get 70% of any additional dollar, and we get 30%. So that's the deal we've been doing for many years now. We've changed it a few times over the years, but it's a good scenario. And our preferred rate of return, we have a preferred rate of return between 6 and 8% paid to the investor, and that's annualized, but it's paid quarterly. If it's short for any reason, it'll accrue. So
right.
If so that way, and then if upon sale, if there's any accrued preferred return, that gets paid to the investor first. So the pref sort of is like the minimum threshold the investor is going to make. There was always a chance that the property sells at a loss and stuff, but our goal is to hold long-term through cycles. You never want to sell when it's a distressed situation. That's the worst time to sell. So.
Okay, I got it. So I like that you keep it simple. It's a 70-30 split on the back end. You mm-hmm. give a pref, as well. So you don't really mess with waterfalls or anything like that, right?
No, just waterfalls and IRRs. That's okay if you're dealing with an institutional partner that puts up 90+% of the money and they're looking for a 3-year hold. Our goal is to really hold these long-term. And we actually, I forgot to mention, we split in the cash flow above the pref, which really aligns us with the investors. Before, we didn't really split in that, and we wanted to sell buildings earlier just to get that back in. But now, if the property throws off significant cash flow, we start splitting in that above the pref, 50-50 actually. So if the building has a 7 pref and the cash flow is 10%, we'll split in that additional 3%, 50-50. So that's been a good way to, just align ourselves where we want to do extremely well and not need to sell the building.
Yeah, that makes a lot of sense. Okay, gotcha. So the other thing I want to ask is, we talked about your debt. You want to go after long-term debt. Usually in these cases, especially in this market. So what is your typical debt look like? Is it 10-year, 12-year? What are you looking at there?
Yeah. So we borrow around 80% of our loans are Fannie and Freddie, and we do a 10-year or even 12-year fixed rate. And I'd rather be safe than sorry. I mean, we've been doing this now 10 years, and most of our loans have been like that. And it's hurt us a little on deals we've sold because rates kept going down, and there's big prepayment penalties on these. And that's the only negative part. If you're thinking you're going to sell the building, in the short term, and if rates go down, then you're in trouble. But on the opposite, if rates start going up like they are now, there could be a lot of value in those loans because you assume them at way below market rates. I mean, we have some loans that are, 100 basis points lower than the market now. And if we wanted to sell the building, I think a buyer would pay a premium to have that. And you could always add supplemental financing. So, the new buyer could come in and add a second on these. We've even bought a building that had a first, second, and third, actually. We assumed all 3 of those loans. So that's the beauty of these Fannie and Freddie loans. You could add a supplemental financing. It's a little bit higher rate, but if it's a small amount, the blended rate is going to still be relatively low.
Makes sense. Gotcha. So I want to go back to your investors. How many investors do you have approximately, like in your database? How were you able to build that database? I know it started from like day one, from the early days.
Yeah.
But how were you able to water that plant, so to speak, or nourish it?
Yeah, so we started with, so my cousin and I, and then my dad was the first real investor. And then outside, we had a gentleman that worked for my dad around 7 years ago. He moved out of the country, and he pinged my dad and was interested in investing his money in the U.S. And my dad told him about what I was doing, and so he was our first investor. And then our next few investors were mainly family friends, and then other people that either worked for my dad or like were clients of my dad's. My dad's an attorney, so he had some clients with some money, and it just spread word of mouth. We just everyone I meet, I try to tell them about what we do, and I'm not a hard sell. I'm just I tell them what we're doing. If they're interested, I then show them our track record and our company bio, and ask them if I could add them to the distribution list. And I think over time, people see how well we're doing, and they've wanted to jump in and become part of the Gelt family. So we have around 600 investors now, and we've raised around $350 million of equity from those investors. So some put as little as, our stated minimum is $100,000 for a deal, but we'll allow someone in for $50,000. A younger person, I'll let in for $25,000. If I see they have a lot of potential to grow over time and become a larger investor. So that's as long as they're accredited, then we can work with them, because we need to make sure they have that requirement to protect us. So.
Yeah, 506C. Yeah, gotcha. Okay, so what CRM system do you typically use to maintain those connections and those relationships with them?
Yeah, so we have we use IMS, which is our reporting and the way we just do all our distributions. We highly recommend IMS. But the way we every time we have a deal that's under contract and we put together an offering memorandum, we'll send it out to all the investors in our database. Plus, we have a large amount of potential investors also that are people that have asked me they want to be on the list, but maybe they didn't pull the trigger yet. So I send that out to everyone, and then just get the commitments. And simultaneously, we're doing our due diligence, both physical due diligence to the property and doing the lease file audit, make sure everything is as advertised. And then we're getting our financing, getting all the insurance in place, just simultaneously as raising all the money. So it happens pretty quickly, usually 60-day process, and then we close on the transaction. And usually we send out within 30 to 45 days an investment binder to the investor that has the closing statement and their membership certificate, title insurance, all the operating agreement and subscription agreement, all the stuff they signed, just to memorialize the investment. And then they could go online and have access to all the quarterly financials and their K1s, and all through IMS. So it's pretty streamlined. But at the end of the day, it's all like I talk to investors a lot via email or phone call, just see them in person, just have a relationship with them.
Okay. So you have pretty significant portfolio today, and over the years you've been working on several projects. So I guess my question is, do you have some sort of or you ever thought of creating like a materials company to be able to like minimize the cost on the construction side and the rehab side?
Yeah, it's a great question. So we did actually go to China to look into stuff like this, and there are ways to probably save a lot of money on the raw materials, but it's a whole business in itself. Mm-hmm. And our time's better spent just really working on finding opportunities to buy and take good care of and hold over time. However, I do know another real estate investment company that they started like a flooring company, and now they're importing the cabinets, and that business is probably even bigger than their real estate business. So we did start an auxiliary business in this space. We started a company called Domuso, Domuso, and it's a financial technology company that is in the apartment space. We handle all the payments on these large apartment communities. So our clients are companies like us. Gelt is a client among a dozen or more large management companies, and it's growing tremendously. We're on around 45 to 50,000 units, going to end the year at around 75,000 units, projected to be on around 300,000 units next year, and really growing very rapidly. And we handle all the payments on these properties and really bring them into a new age where you can pay online. There's no more cashier's checks and money orders. We've eliminated that completely. We have our own certified funds product. We have it's a full financial services company. We have point of sale financing, so any renter could finance any payment due to landlord on approved credit. A lot of innovation all around the payment of rent. So I'm not running that company. I invested in it. My cousin who started Gelt with me is running it, and it's, God willing, going to be bigger than the real estate investment company too. It's on its way. So definitely started something where we saw an opportunity where checks were still being paid for rent, a lot of theft and loss, and time spent on the manager, and they were really acting like a banker and trying to figure out the credit of the resident. We're trying to streamline it and bring in technology to evaluate credit risk and to just handle all the payments and decouple it from the actual property management company. Let them manage the property, but not have to deal with all the payments. It's akin to like a car dealership. They don't handle all the monthly payments and stuff, but they service the vehicle and sell the vehicle. The financial component is completely separate. So that's what we've created, and it's growing really quickly. So
yeah, no, that's very interesting. And you said that's called the Muso?
Domuso, yeah, DOMUSO, and the root word is like domo, DOM or something. It means home, so like dormitory, domicile. So Domuso, it's a made up name, and but that's how we create it.
Yeah, no, but it sticks. Yeah, no, I like it. Okay. And so where can people go to find out a bit more about that?
Go to domuso.com, DOMUSO, and if you're involved with any large properties or you have a management company that has a large portfolio, we'd be happy to talk to them. Definitely.
Sweet. Okay. Well, yeah, that's very interesting, and it's a good niche as well. So, yeah. Awesome. So, I want to ask you as well. What has been like the biggest overall factor to your growth? Like if you could choose a couple different things. It could be one or two things. What do you think it has been?
One is having good partners and team members. I'd say every week I have people approaching me that want to work with us, and I don't really advertise that we're hiring, but we'll try to create a position for someone if we really like them. So I'm constantly meeting with people, and I'd say having, without the investors, we wouldn't have a business. So having loyal investors that are happy with our performance and happy to work with us is number one. Number two, it's been a great market since we started at an opportune time, and it's great that I'm so happy that we were able to buy the things we bought. We're being more selective now as we're into a 9 or 10 year cycle. Eventually there'll be a little pullback. I don't know. I don't think it'll be as bad as the last one, but there'll be some kind of pullback, and hopefully we'll step up the buying a little more. But I'd say as prices go up, you just be more selective, and which we are, and try to do different things. We started buying mobile home parks before that was really hot and sexy. Now all the large institutions are coming in there. We bought an RV park even, which is a unique kind of asset in the Bay Area of California. We started doing some ground up development locally here in LA, where we saw opportunity. We're focusing on opportunity zones, which is a new, the IRS has this new regulation that you're allowed to invest in certain geographic areas and postpone taxes essentially on any capital gain. So we have some investors that have sold their businesses, and we're trying to help deploy some of their capital in these opportunity zones. Just trying to be, resourceful and see things a little differently than anyone else, Yeah,
no, that makes a lot of sense. So I would say your outlook, now that you kind of talked about that a little bit, just a little while ago, your outlook on the market is, it's gonna change a little bit, maybe in the next 6 to 2 years, who knows? But you don't think it's going to be as bad as it was back in 2008?
No, I don't think it will be as bad. And we're cautiously optimistic. As long as you're able to withstand the downturns in the long run, you're going to be great. So that's why we do that long-term fixed rate financing. For the next 10, 12 years, we're going to know what our monthly payment's going to be. We're not going to have any surprises if interest rates start going up, or as long as the loans don't come due at a time where, interest rates are way higher and stuff. And even 10, 12 years, we're going to have all this cash flow over the years. And, it's just a lot safer. And we're buying things with lower leverage, 60 to 65% leverage, maybe 70 tops, whereas before we were 75, even 80% leverage. So you just got to adjust with the times, I'd say, and adjust strategies and just be opportunistic. But we're cautiously opportunistic. We still love the apartment space. We still love the workforce housing space. But there could be a time where there's a lot of distress in the brand new buildings because there's been too many built in certain areas. So we're cautious. We're monitoring that and seeing if there's any opportunities to buy newer buildings, but at reduced prices. So we're never. I don't want to be pigeonholed into one area. We want to always look at what's going on and think opportunistically.
There you go. That's the way to do it. We focus more on multifamily, like on this show. So, what's the next hottest market that you're seeing? Where are you going?
Yeah, so we just bought we're closing this Friday on a self-storage building. Overall, this space is seeing a lot of more vacancy because there's been so many. If you just look nationwide, there's been a ton of these facilities being built. We're buying one in a supply-constrained region here in Los Angeles, where there's like a moratorium on new building for these self-storage facilities. They don't create the same kind of tax revenue and jobs as other kind of business, and we believe it's a long-term redevelopment site. So, and also the rents were severely below market, and just it was being marketed more as a development site. And we're just going to really turn it around in terms of operate it more efficiently. And if it is a long-term redevelopment site, that'll just be gravy. We didn't underwrite it to develop it, but I think long-term that'll be a great way to have a higher and better use for that site. So, self-storage in certain areas that are really supply constrained. I like industrial. We started looking into that. It's getting pretty expensive, but with the whole last mile logistics and e-commerce, I think that's going to just continue to grow, and there's going to be a big demand, bigger demand even for industrial space located near job centers. So I'd say industrial would be the next thing I would want to do. Retail in certain areas, if you're a specialist in that, and pick the right locations that have more service-oriented kind of things and experiential retail, I think is a good opportunity. People are all doomsday on retail, but retail is just changing. There's a lot of, they call it omni-channel retail, where you have the clicks and bricks and mortar and the online, and it's all combined instead of just having just the retail separate from the online. And it's like you have these new brands that started online that are now opening retail locations, and because it's becoming much more expensive online to like advertise on Google and Facebook and stuff. So they find it better to have actual retail locations now. So it's even Amazon's opening retail locations. So
it's crazy how things are kind of switching a little bit, Yeah. Okay.
So
Sweet.
There's opportunities everywhere though, for sure.
Yeah. Just be opportunistic is the key here, right? So, okay. Well, Keith, it's time for our nuggets of wealth, and these are questions that I ask, pretty much every guest every week, and hopefully they are able to help out our audience. Question number one: what is a good tool, source, or platform that you use almost every day that can also help others?
Yeah, I'd say number one is Slack. We use Slack in the office to communicate. We have 19 people here in the office, and it's cut down on a lot of our emails, back and forth to each other. Slack's a great communication tool. And number two, I'd say people sort of are giving social media a bad rap, but I'm very active on LinkedIn and Twitter and Instagram, and not as much Facebook anymore. It's weird, but I met a lot of great people on Twitter that I've learned a lot from, and I get all my news now on Twitter because I follow people that I'm interested in certain sectors like real estate, technology, and they share their ideas and thoughts and articles, and I get the best curated news from that rather than watching television. I haven't watched the news in years. I'll read the Wall Street Journal, LA Times, and then online, social media.
Gotcha. Okay, sweet. Yeah, that's good. What was the best business advice you ever received?
In terms of real estate, I'd say time and inflation are real estate's best friends. The second one is one of my mentors taught me he'd rather regret not buying a property than buying a property that's going to cause a lot of heartache. So that's another good one I've learned.
Okay, nice. Those are two really good ones.
Yeah.
What book are you currently reading?
I'm reading Howard Marks from Oaktree, his newest book. I've tried to read all of his books. He's a really, amazing thinker, and the creator of Oaktree, one of the largest alternative asset management companies in the world. And I just like his memos and the way he thinks, and just great thinker. So I try to read all of his stuff.
Yeah, I just actually came across his work, and found out about him, and digging more into him as well. Yeah, so that's good that you brought that up as well.
Yeah.
What is the best strategy for you to manage your time?
I recently, well, not too recently, a year and a half ago, we made our best decision hiring. I hired a personal assistant, and now she schedules all my meetings, and my productivity's gone up tremendously because you spend so much time going back and forth scheduling meetings, and I'm getting busier and busier as we become more successful, and it's a lifesaver having someone to help schedule all the meetings and coordinate things in the office here. So that was a big one for us. It was worth the investment. And what was the question? What other?
No, that's pretty much it. I mean, what is the best strategy you use to manage your time?
Manage time, yeah. So the assistant, and I'd say that's the best one right now. Yeah.
Yeah, no, that's good. Yeah, that's really good. Where do you see your business and company in the next 5 years?
Next 5 years, I'd say hopefully going to put the pedal to the metal, start buying more as if we see a little dip in the market. So keep acquiring apartments, mobile home parks, and do selective development here locally in Los Angeles. Keep growing Demuso, the financial technology company. And then we didn't really touch upon it on the show, but the Resident Relief Foundation, we started our own 501c3. We've helped over 50 families and individuals stay in their homes. A lot of them were actually in Houston. So when you had your big, the Hurricane Harvey, was it, that went through?
Yeah, Harvey.
A few people in Houston through their management companies contacted us, and they had their jobs that were temporarily closed because of the damage. So they didn't have any income coming in. And 60% of Americans have less than $1,000 in savings, and they just weren't able to make their rent for a month or two. Mm-hmm. So we gave a grant to them. We don't give it to the resident. We give it to the management company for the purpose only of paying rent. That way they can't use it for anything else. And we've helped these people were going to be on the streets. They had no other place to go, no family members, just really in a tough situation. So we're helping responsible renters that have a financial crisis stay in their home. Around 30%, 40% would be homeless. We have a lot of veterans that we've helped, families, just a lot of different. You could go to the website. It's residentrelief.org. Check it out.
Yeah, you're awesome for creating that, and what I like about that as well is that you're able to kind of keep it in house, like so to speak, like you're in the real estate space, and you're able to help out tenants, and tenants that are on your properties, so. That's a really good way to give back.
Yeah, we've only actually helped one of our own tenants. I'm trying to get all the rest of the real estate world involved, and we're forming a board with other management company owners and really trying to elevate the perception of the landlord being a money hungry, greedy landlord, and trying to get people that are just wanting to give back and we have a heart for renters and trying to elevate the status of the landlord and not being so greedy and money hungry kind of thing. The perception.
Okay. Yeah, no, that's good. That's good. So at the end of your life, how do you want to be remembered?
Well, that's a good question. I'd say by what we've created in terms of creating better homes for people, creating new homes for people, helping people stay in their homes, helping different charitable organizations that we're very involved in. I'm a Jewish big brother, so I was matched with my little guy when he was 11 years old. He's now 17, so around 6-7 years we've been together. Just the impact I have on others, I'd say, is the most important thing.
There you go.
Yeah.
Love that answer. Okay, so it's been a great pleasure to have you here, Keith. So where can Commit to Wealth Nation go to contact you and find out more about you and what you're doing in your company?
Yeah, I'd say find me on LinkedIn, just type in my name, Keith Wasserman, find me there. Twitter, it's Keith and then _ Wasserman. Instagram, I think it's KF Wasserman, F is in like Frank. Those are 3 things. Or you could always email me, Keith at geltinc.com, and that's GELTINC.com. And just thank you for having me on the show, and I hope I provided a little insight. And if anyone listens to me and wants to contact me, feel free to reach out. Yeah, that's what it's about. I love that. So thank you as well for providing a bunch of, value and information. And, you definitely did. So, thank you so much for that. And I wish you continued success. Awesome. Thanks, Juan. Yeah. Thank you, Keith. It was good. It's a wrap. It's a wrap, man. All right, cool. Awesome. And we got you out, in time. So I kept an eye on that clock. I was like, man, I got to get him out of here before it's too late. But perfect time. Yeah. So, yeah. Hey, it's been great. It's I know we haven't met in person, but it's I feel like I know you a little bit because I've seen you on some couple of different shows and your videos. But yeah, I really do wish you continued success, man. You're doing awesome. Send me the link once it's ready, and I could share it on all my social media also. So yeah, definitely. Yeah, I'm gonna follow you also on LinkedIn and Twitter. Okay, sounds good. Yeah. Awesome. Okay. All right. Take it easy, man. Have a good day. See you. Yeah, you too. Bye.